Hey, this is Rob Beardsley with Lone Star Capital. I'm here in Fort Lauderdale at a mastermind event for the weekend. It's going to be a really exciting event. We'll be talking about wealth, entrepreneurship, and obviously multifamily investing. So some fun, good vibes, good graphics. I wanted to shoot a quick video talking about Howard Marks' newest memo. So if you know me, you know I'm a huge fan of Howard Marks. He writes really thoughtful quarterly memos about his thoughts on the current events and his investing principles. He's a very conservative investor. Oaktree Capital, his firm, specializes in credit. So it just leans more towards downside protection rather than equity and upside. So that's where he comes from. But this latest memo talks about value versus growth. And it's a very popular topic lately because value, which is the school of thought of Warren Buffett, Benjamin Graham, Charlie Munger, has been known as the smart way to invest, and growth is chasing growth. It can be speculative, but growth has beaten value over the last 10, 20 years handedly. And there's various reasons for that. Technology is a big one. Secular downtrend in interest rates is another one. So the question is value dead? And Howard comes from the value school. His son runs a growth capital firm, and his son obviously thinks growth is very much alive. So it's an interesting dynamic. He talks about how him and his son will have back and forth conversations about the topic. But in the end, you can realize that the principles of value investing, where you're trying to buy something for less than what you think it's intrinsically worth, applies to all forms of investing, not just value investing, which is also can be referred to as cigar butt investing, where you're just looking for not a very high quality asset that has a little bit of life left in it, and you puff the last bit of the cigar and get the last bit of value out of it. However, like I said, with value investing, you can get those value principles applied to growth investing. And so what are the value investing principles? Well, like I said, it's first of all, trying to buy things for less than what you think they're intrinsically worth. And so you're valuing based on discounted cash flows, and those same principles can be applied to growth. Just because you're buying something at a high multiple, or in real estate, a low cap rate, doesn't mean you're not buying value. Because if you underwrite conservatively and you accurately forecast growth, you may very well be able to buy something for less than it's worth in a growing market. So that's the concept in his memo, is that, hey, value versus growth, it's not a binary thing. You don't have to pick one or the other. You can implement the benefits of both into your investing strategy. And today, it's really hard to avoid investing in growth because you really will be left behind. If you look at the S&P 500, it's more and more being comprised of growth companies that have no dividends, maybe don't even have revenue, or at least positive EBITDA, but are the companies of our future, and they're going to bring outsized returns to your portfolio. Applying this concept to real estate, again, it's not binary. You don't need to, if you're a value investor, you don't need to go find a no-name tertiary market where the cap rates are 8% and say I'm sticking with this. I don't care if there's ever rent growth in this market ever. I'm happy buying my 8 cap and I'm done. On the flip side, if you are on the growth side, don't just go to Phoenix, Denver, Dallas, Atlanta, Tampa, and pick any asset there and say, well, this is a fantastic market. This market's going to grow and grow and grow. And so I'll buy here at a 4 cap and it won't matter. It'll all work out. The right answer is somewhere in between. It's applying those value fundamentals to growth markets. So holistically underwriting, factoring in today's prices, today's income, and future growth. Thanks for watching.